to 7.5%. Very interesting time we have. And Saurabh is going to tell us how we can make money. And the interesting fact is, you know, we can invest from 10 years, 5 years, 10 years, up to 25 years. So even at 0.25% move of the interest, if the effect is very huge, and it is necessary that time has arrived that there is a need to diversify, and there is, in my opinion, uh, there is an opportunity for all retailers and to invest in retail bond, and not only invest and look at how you can where off your investment when the gate comes 5.75 and again re-enter 7.5%. So to give brief introduction of Saurabh, Saurabh is an MBA from MBA Gurgaon in Finance and Strategy. So he worked in Axis Bank in foreign exchange as well as bond, and now he's into business of his own. Zen Fintech is a managing director, and he in this business he manages foreign exchange risk, trading, and also portfolio management, and he has a family business of financial broking. In addition to that, they are running educational institutions. He also participates in it. He has a hobby. I know he used to run. I think he stopped for a while. He was a run marathon also, and his hobby is to play chess and music, and option strategies also. Saurabh is known for that. With this introduction, I request Saurabh to talk on today's topic, Zen Special, how to be a successful trade trader. Yes, over to Saurabh.
Thank you very much, sir. Thanks for that kind words. And how do I push this up? I have to go to the Zoom tab, is it? Okay. I'll just share my whole screen, right? Please share this. No, I need to share this as well later. So share screen first. That will still stay. I've removed this. Okay, that is on that line. So that is on that. Yes. Okay. So good evening, everybody. Thank you all for joining in, and I know it's been a long day, and then we've just had our CPI numbers come in at 5:30. Anyways, so when we talk about rates, what we're talking essentially about is interest rates, trading of interest rates. I put my money in the bank, I get some interest on that. What do I trade there? So what is the question then arises, what is trading of interest rates? So we are here to discuss that. But before I get into exactly what it is, let me tell you that it definitely is very easy. Why? Because you can't lose money. Today, you buy a government bond and you get an interest of 6% on that. What is the maximum drawdown in a year that you see that a government bond will go to? Or if I hold it till maturity, I will get the face value of a bond. Some of these terms that I'm talking may sound a little distinct. Bear with me for 2 minutes. I will come and explain each of those terms. However, if I and there is no security. Thank you. So, so if you lend money to say the government of India and they are paying some interest to you, where is the downside? You can't lose money. At the most, you will earn lesser amount. So for that purpose, it is easy. However, rates traders, especially the bank people who have joined us, would understand that there will be MTM. MTM is mark to market. So during the tenor that you hold the asset, if the prices move up or down, there will be some mark to market profits as well as losses. So it's not all hunky dory. You are expected to generate alpha. Banks don't hire you and make you sit on a desk and pay you like 5 lakh rupees a month for doing just buying government bonds and sitting on it. You are expected to generate something more on that so that bank earns an alpha on the portfolio. And you may not have such a long time frame. Government bonds, as Sir put it, it starts at even 1 day to 40 years. There are 40-year papers available, but you can't say that, okay, my paper is now in loss, so I will hold it till maturity. I will sit on it for 40 years. The bank is not going to tell you, okay, I will review your performance 40 years later. That's not how it happens. So, in that context, let us try and understand what is interest rates trading. Interest rate trading basically is trading of a promissory note. The promissory note is nothing but bond. What it says is that I have borrowed X amount of money from you. I will pay you Y amount of interest on that. And at Z maturity, I will pay the entire amount back to you. That is a promissory note. And that is exactly what the bond says. It has a face value, it has a coupon, and it has a maturity. So when you, now what you've done is that loan that you have given to somebody, you have assetified it, you have securitized it. And now that security can be traded. So today I have given the loan to a party A, gives the loan to party B. Then party A says, I don't want to take this risk on party B anymore. So he sells that loan to party C. And then party C in turn sells that loan to party B. But in effect, they're not really selling the loan, or they're not making another agreement with the registrar. All they are doing is they've securitized that asset and they're just taking that security and passing amongst each other. And that is interest rates trading. Now understand, if you are giving the loan, you are the, in the context of government security, if we are giving the loan to the government, which means we are the lenders, then who is the borrower? The government. The government is the borrower, which means that the seller of the bond is the government. And for the entire outstanding GSEC of some 89 lakh crore that the government has, that entire outstanding government securities, they are the one side of the transaction. So to trade interest rates, you need to start thinking, how would the government think? What should be the government's reaction to a particular situation? They would want to reduce their borrowing. They would like to reduce their borrowing costs, which means that they would not want the yields to go above a certain level. So once you start thinking in the direction of the government and the central bank, it's a cakewalk. Because then you know that this is a place where, so I'll give you an example to what I just said. Last monetary policy, just before the monetary policy, there was an auction of government securities where the RBI deballed a certain paper at 7%, the 10-year paper at that time. They were uncomfortable with yields above 7%. So the market was asking that paper for more than 7%, but RBI said nothing doing, 7% is the cutoff. I have deballed it. Right? Now, during the monetary policy in the press conference, some person asked the governor the question, directed question, that is there a particular level of yield that you are not comfortable above? The director, the governor is not in a position to give you a clear-cut answer to that question. But he very succinctly put it that our actions in the past week would have told you what we are comfortable with. He put that comment. Now, it is very clear at that point that 7% is now the cap. If it ever goes to 7%, I want to buy bonds. Eventually, the situation of inflation became worse. The US yield started moving up. Now, in the last monetary policy, which happened on the 8th of April, Dr. Michael Patra clearly said this, that we are now a little more comfortable with the yields being a little higher. Because the difference between our yield and the US yields have now gone this thing. Now, so how much has the US yields moved up? Will give us how much comfort the RBI has. Because all they are saying very clearly is that Indian yield minus US yield should be at a particular level. At 7%, they were not comfortable, above 7%. What was the US yield at that time? What is the US yield now? At the same amount, and you know that this is my cap, this is my new cap. At the moment, you should look at 7.5. But things are changing every day. You can have a different number going forward. So, what I want to say is interest rate trading is as easy as that. All you have to understand is from a macro perspective. Problem that happens is when we start doing it day to day, we lose the third party view, we lose the bird's eye view, we lose the macro view, and start doing in the small, okay, I'll make 10 paisa right now, get out, make another 10 paisa, get out. I made today 2 lakh rupees, I made today 10 lakh rupees. We are closed into that game. So we lose the larger picture a lot of times. And in interest rate trading, you can't do that because it is a long-term game. So, what are the instruments available in interest rate trading? As I said, you have from the tenor of 1 day to 40 years available in India. You have the SLR grade securities, which are your government securities, treasury bills, cash management bills. Then you have your non-SLR securities, where corporate bonds, perpetual bonds, floating rate bonds, quasi-government like the PSU bonds, they come in the non-SLR category. Then you have the money market instruments where you have term money, 1-day call money, repo, reverse repo, TREPs. So all these come into your money market instruments, which are the short-term ones. And then the OIS. OIS is overnight interest swaps, where basically you are swapping the interest rate from fixed to floating. It's a very good instrument, especially for hedging of your security. However, it is being handled by a very, very few people. So banks have access to that platform. However, very few of those banks actually have an OIS desk. And then there are something called interest rate futures and interest rate options, which are available on the exchanges. Here, even retail traders can take advantage of the government securities market. And in addition to this, RBI has opened an RBI Retail Direct platform, where again retailers can go and purchase government securities, even sovereign gold bonds, even SDLs, they can purchase from there. And it's a fabulous platform. However, till now, they don't have a mechanism where they can transfer it to your demat account. So they give you those securities in your RBI Gilt account, and then you can trade through that. They are working on the demat version as well. So interest rate futures as well as interest rate options on the exchanges allow you to trade in very low quantities also. And those are fabulous products for even banks to hedge their products. I'm going to show you some examples on that as well, how they can do that. And there is arbitrage available. Because if there are two markets which essentially do the same thing, there are bound to be inefficiencies, there are bound to be price differences, and someone should come and take that arbitrage, this free money lying on the table. Then auctions, issuances, SGL, CSGL, all these accounts, there is underwriting which happens. There are so many ways you can make money out of interest rates, especially for banks and PDs. The last line is mostly for the banks and PDs because they have a huge book which they are running, and every auction they are underwriting the entire auction. An auction which is of 30,000 crores, if they are underwriting, they earn as much as 2 to 3 crores per auction just for the underwriting fees. So that's a huge source of money. So some terminologies, as I promised to you earlier, I'm gonna very clearly tell you what the terminologies in the debt markets are. Any bond that you get will have a face value. It can be different from the value of the bond. A 10 crore bond can trade at 10.5 crores. I hope you understand that. So the value of the bond and the face value of the bond can be two different things, market value and the face value. But the face value is upon maturity, that is the amount that I will get from the borrower. That is the face value. There is a price. Now this price is nothing but the market value. It can be different from the face value, as I just said. Coupon. Coupon is the interest that the borrower has promised to pay you. In the case of government securities, it's a semi-annual cycle. They pay you once every 6 months, the interest. The time to maturity is very clearly mentioned on every bond that this is my maturity date. On this date, I will give you your money back. The current yield. Current yield is an important concept. Basically, what it says is that what is it that I will gain if I invest in this? Now, what is it that I will gain is I'm only getting the coupon for now. I will get the yield at maturity, the entire money back at maturity. But for now, I'm getting the coupon. And what am I paying for that? The price of the bond, the market value of the bond. I'm not paying the face value. It can be 95 rupees also, it can be 105 rupees also for a 100 rupee bond, right? So current yield is nothing but the coupon divided by the market value, because what I'm paying and what I'm getting. And the yield to maturity is everything that I will get till the maturity of the bond. So all the coupon payments plus the final payment that I will get, I use a time factor of that. So I have to discount it by the time factor because I'm not getting everything today. I will get something 10 years from now. So by discounting it with the time value, I get the YTN. Day count convention is very important because different countries follow different day count conventions, especially when you are trying to use Excel to get your yields and your this thing. You have to give which convention do you want to count. Do you want to count a month as 30 days? Do you want to count the number of days as actual? Do you want to count a year as 360 days? Or do you want to count the year as 365 days? Or as so there are day count conventions. You have to mention it very clearly. Otherwise, your calculations can go wrong. We are not going to do this. We are not going to do bond mathematics today. So because it's a huge topic in itself. Indian convention typically is 3360. 1 month is 30 days, 1 year is 360 days. Yeah, for bond purpose. So some more terminologies. When you are buying bonds, you trade, the price at which you are trading is the clean price. Right? However, there is something called a dirty price. What is the difference between the two? Is the accrued interest. I'll explain that with an example. Say you buy 650 for 2032. This is the present 10-year benchmark paper. Now, understand, I've taken this paper to give you that reference. 654 2032. What does that paper mean? What is the coupon? 6.54% is the coupon that the government will pay. When will it mature? In 2032. So the bond itself is just called 6.54% 2032. That defines the bond nomenclature. Now the maturity of that is on 17th of January 2032, which means that the interest would have been paid on 17th of January 2022, the last interest. So if I am buying the bond today on 12th of April, somebody who's selling me the bond, he did not get the interest from 17th January till 12th of April. How do you account for that? He was holding the bond, which means that interest belongs to him, not us. I will get interest from 12th of April because I'm buying on 12th April. In fact, the settlement date will be 13th, but for simplicity's sake, let's take it as 12th of April, right? So I will get it from 12th. From 17th of January till 12th April, we will calculate the accrued interest, and while making the payment, so if I buy the bond at say 101 rupees and it's a 10 crore worth of bond, so I will pay him 10 crores 10 lakh rupees as the clean price plus accrued interest till 12th of April, and that will be my dirty price. So my actual payment is usually much higher than what I see on the buying. So if I go to an RBI retail direct and I buy at a particular price, you may have to pay more. Please don't get shocked because that is the accrued interest. It actually belongs to that person. When the next payment date will come, that will be on 17th of July, 6 months from this date, right? So at 6 months, 17th of July 2022, you will get the full interest from 17th January to 17th July. So you're not really giving something out of your pocket. It's just that you will get that money back from the government, right? So that is something called dirty price. Another very important concept in bond trading is called term structure. Now, everyone who's there, whether it's a new person who's now investing in bonds or a bank trader, please try and understand this concept very clearly, because if you look at term structures, and you are able to trade with the term structure in perspective, then more often than not, your trades are going to be profitable. Because this is exactly how interest rates function. However, this is a very macro perspective of interest rates. Let me tell you what term structures are. It is nothing but a yield curve. So a normal yield curve looks something like this. It's a graph which is drawn with yields on your y-axis and maturities on your x-axis. So what it says is, as the maturity becomes higher, the longer tenor bond should be a higher yielding bond, right? If I am taking a risk for a longer time, would I want more money for my more interest for my money? I would, right? So this is a normal yield curve. Then we see there are some times that we have flat yield curve. Irrespective of the maturity of the bond, the prices are similar. And then there are times when there are inverted yield curves. Like this, the US yield curve at the moment is inverted. You would have read reports that the 230 curve has inverted. The 30-year bond is yielding lesser than a 2-year bond. So why would you invest it for 30 years? 2 years you should invest, right? So there are inverted yield curves. So now when you are strategizing, first thing that you have to understand in interest rate trading is, where on the entire curve should I invest? What happens typically in banks is everyone's just going for the 10-year benchmark. The 10-year benchmark trades 50% of the total bonds which are available. Thank you. Thank you. So the 10-year benchmark trades almost 50% of the volumes of the entire market. It is that skewed because all people are interested in कि आज का 10 पैसा बना के निकलो. My objective is get my today's target done. However, if you look at it from a macro perspective, there's so much more money to be made with so less this thing involvement on a day-to-day trading. So what we need to understand is how the term structure will shift. What it is today, everyone knows, but how will it shift? So then only I can take a view, right? Where to buy, if it shifts this way, that way. So this is your normal yield curve. There is something called steepening. So if your view is that the term structure or the yield curve is going to steepen, there are two ways that it can steepen. Okay, let's see this. If I have this curve and I tell you this curve will steepen, look here. If I tell you this curve will steepen, what can happen? Either the long paper start moving up, or the short go down, or both, right? So if there is the short maturity start moving down, yield is inversely proportional to price. Please try and understand this, that if it is moving down, if I had invested in the short term paper, I would make money in this situation. The yields are coming down, which means the prices are going up. So if I had invested in short maturity, I would make money. This is called a bull steepening, where the lower end of the maturities start moving down, the yield curve shifts, it steepens. However, this comes down and this stays there. A very good way to trade this is to buy the lower maturities and sell the higher maturities, maintaining your same CVO1. I will come to that. There is a concept, I will come to that, I will explain. So the very easy way to trade is a completely hedged position where you buy this and sell that. So if your view is that it is going to bull steepen, you do that. In fact, if it bear steepens, also you do that. Any steepening, you buy the lower end and sell the higher end. If your view curve will steepen. Now US is inverted. Eventually, the central bank is going to work towards making it a normal curve. Right? So you will make money if you do be on the right side of the the next shift is flattening. So if I have to flatten, I can get this up or this down or both. So if the lower end starts, okay, so if the longer end starts moving down, this is called a bull flattening. Why bull? Because if I buy and the yields come down, I make money, right? Prices go up. If the yields come down, prices go up. And so this is called a bull flattening and this is called a bear flattening. In such a situation, you buy long end and sell short end. See, here we are taking zero interest rate risk. Please try and understand, in this entire thing, हमने interest rate risk किया ही नहीं. Whether there is a rate hike or there is a rate cut or there is nothing that happens in the economy, inflation goes here or there. This is what, if my steepening and flattening view is correct, I make money. It's a basis game, pure arbitrage. And then there are something called parallel shifts. Parallel shifts are basically taking a view on the interest rate. The entire curve is going to shift down. So I buy bonds now at 7.5 because I believe that the entire curve is going to come down. When I say 7.5, it means the 10-year point. We always talk of the entire curve as just the benchmark point. Otherwise, I don't know which point to talk about, right? It becomes, so just for ease, we have always, we talk about the curve as the 10-year point. So at 7.5, I feel the entire curve is going to come down. I am going to buy and sit. Which side I want to buy and sit? That depends on whether I feel it will steepen a little In that case, I'll buy the smaller end. I feel it will flatten a little, then I'll buy the longer end. So what is the current shape? Can tell you. So you take out a long-term average shape of the yield curve, and what is the current shape? Is the long-term steeper or flatter than what it should be? Simple as that. So you can choose which maturities to go for. Sometimes it is preferable to go for 5-year maturity. Sometimes it's preferable to go for 20-year maturity. And then there is something called a bare parallel shift. Bare parallel shift is where the entire yield curve moves. This thing at that time, if you bought, you're going to lose money. So, keeping yield curves in mind, you can make a lot of money just by not taking any risk. Now, coming to taking some risks on your position. When you take risks on any asset class, when you are trading, you need to quantify that risk very well. If you can quantify that risk, you are able to understand what am I to lose if such a situation happens, what am I to gain if such a situation happens. Is there a higher probability for me to gain? Only then I go and enter the trade. Simple, very, very simple concept of any trade, irrespective of asset class. So how do you quantify the risk on any security, on an interest rate security? That is done by something called duration. It is called a Macaulay duration. It is a mathematical formula. Again, I'm not getting into bond math. There's a modified duration which comes after that. And from that, we derive the PVO1. So what is PVO1? PVO1 is the present value, how much my bond value will change if the yield changes by 1 basis point. O1 is 1 basis point. 1 basis point is 0.01%. 1/100th of a percent is 1 basis point. So अगर 1 basis point से yield change हुई, तो मेरा bond का price कितना change होगा? That is what is my present value PVO1. So from Macaulay duration, we derive the M duration, and from that we derive the PVO1. So I'm going to quickly, there are a lot of calculators available for the sake. I'm going to show you one very quickly. So I put in today's values, just see the row number 3. 654 2032 security. Okay, now on 12th of April, if I buy this security for, if you see I column, face value, okay, let me highlight that. So, okay, so this is 10,000 lakhs, which means 100 crores. 100 कोटि का मैंने security लिया 654 2032. What is my this thing? All these are Excel formulas. Please see on the formula tab. Yield is coming by the Excel. Duration is being taken out. M duration is being taken out by the Excel. PVO1 is nothing but the price into the quantity into duration. Right? So what basically this says is that I stand to lose on my 100 crores position if 1 basis movement happens in the interest rate. I stand to lose 6,62,000, or I stand to gain 6,62,000 if 1 basis movement is perfectly quantified. So if RBI comes tomorrow and increases the rates by 25 basis points, this into 25 is what I stand to lose on my position. Simple as that. Right? So we have very easily quantified it, which is why interest rate trading is so easy. Because you can quantify the risks to the last paisa. Right? You can make an Excel and quantify this is what my portfolio is, what is my running risk. How much will the interest rate? Okay. So I will come to that slide again, but if we are doing government security, is there any credit risk? Zero. Right? So the only risk basically then that which is left is interest rate risk. If the market, if the RBI comes and hikes the rate or cuts the rate, then there is some risk on the portfolio, right? So this is basically if I hold 100 crores worth of bond, I stand to gain 6,62,000 if the interest rate reduces by 1 basis point, and I stand to lose 6,62,000 if the rates go up by 1 basis. So with duration and PVO1, I wanted to explain to you just that. So coming to something called IRF and IRO, interest rate futures and interest rate options. How we can use these to take advantage of movement in the interest rate. There is a lot of arbitrage opportunities which are available on this platform. Now, what happens is whenever a new platform comes, whenever a new product comes, there are, especially for the bank traders, whoever has joined us, there are a lot of arbitrage opportunity because there are inefficiencies in the market because it's a new product. Not too many people are there, and those inefficiencies lead to mispricing one or the other, and that mispricing should be captured in, which today is available with money lying on the table, screaming that please take me. Nobody is taking that money. There are arbitrage opportunities. So I will give you an example right now. If I had taken that 100 crore position, on the exchange, you don't have the 654 2032 paper right now. But you do have the previous 10-year benchmark, which is 610 2031. Now, let's talk about row number 4. So in IRF, simultaneously, what I did was I sold 610 2031 when I bought 654 2032. Now, how much should I sell? I bought 100 crores worth of that paper. How much should I sell here? All I have to do is I have to maintain the same PVO1 on the negative side because here I have sold, so PVO1 should be negative for me, right? So when I sell that 610 2031, I sell 5348 lots of 2031 paper. That gives me a PVO1 of minus 662, which is identical to plus 662. Now here, whether the interest rates go up or down, I am totally, completely hedged. Tomorrow, when the prices, there is a mispricing, I will hit one side there and one side on the OTC, and I will take advantage of both and make my money without taking any risk to my portfolio. I put another example with 2035 paper, but I think due to paucity of time, we'll move a little ahead. So, what I want to say is there is always a pattern in every chaos. Recognize it, identify where you are able to make money, go in and make it. And IRF and interest rate options is another field altogether. It's another Pandora's box altogether waiting to be opened because there are so many strategies that you can then develop on it. So what we were here discussing today is how to become a successful rates trader. All what we discuss is about interest rate trading as such. How do you become successful? Successful trading is all about management of risk. Profits will come. Profits are only the byproduct. You have to understand how you can manage the risk and take only as much risk as you desire. It should never be more than what you want to take. So when we say risks, we have to manage the risk. Then we need to identify the risk. Basically, in interest rate trading, what you have is market risk, the movement of the price itself, the credit risk. When you do corporate bonds, there are credit risks also involved. Then interest rate risk, if the RBI comes and hikes rates. Then duration risk. What is duration risk? If you start taking a 40-year paper, you are holding a lot of duration in your book, right? So even a 25 basis point hike will move your portfolio wildly. Versus if you have a 1-year paper in your book, it is the same quantity, but it has a low duration, which is why the movement of the price becomes low. Then duration, and then the basis risk, which is what we did when we said we're taking basis risk. When we're buying a short maturity and selling a long maturity, if the yield curve moves this way, we lose money, right? So we need to, there is a basis risk. Even though we have covered our interest rate risk, there is still a basis risk in there. And operational risk is always there in everything. You, instead of buying at 101, you bought at 101.50, you put a wrong trade, something like that happens. Operational risk is always there in trading. You have to be very careful. Okay, so this is for the bank traders who have joined us. Are there any out here? No. Okay. Any bank, when they give you a target, they give you a portfolio size of say 1,000 crores or something like that. Do you know how much alpha that you really need to generate to be successful? I know people out here are not bank traders, but it is only 20 basis points. If you are able to capture 20 basis points in 1 year, you have been successful in your trading. When I say 20 basis, I mean on a 10-year maturity. Obviously, 20 basis on a 1-year maturity is going to be very less, and a 20 basis on a 40-year maturity is going to be very this thing. Yeah. So only 20 basis points is what you really require to be successful. It is very, very easy to generate that. Every policy, every monetary policy, we have 6 monetary policies in a year, roughly around 10 basis point movement happens. If you capture 2 out of 6, you've done your job for the year. Only 2 days in a full year, if you've captured correctly, you're done for the year. That's how this thing is. But again, this is for a bank. Since we don't have, I'll just quickly tell you what happens is traditionally what we see in India is there is a bank setup where there is a forex desk, there is an interest rate desk. They don't talk. They don't interact with each other. He's running his own book. He's running his own book. What is happening? There are so many. Each of those products are interrelated. You know that you've worked in bank. Each of those products are interrelated. Today, if I am having a forward pricing, it is nothing but the interest rate differential between my currency and the foreign currency. Similarly, if I do a PRA, if I do a CCS, everything is interrelated. So, if I have a holistic approach, I have money. I am a treasury, I have money. I need to deploy that money in the best possible manner to earn the most amount of money, most amount of returns in that. Now, why should that be restricted that you take this 10 lakh or 10 crore rupees and invest in dollar rupee? You take this 10 crores, you invest in euro. You take this 10 crores, you invest in DSEC. You take this 10 crores, you invest in corporate. And you separate the entire desk for your own operational convenience. And in effect, what you've created is inefficient. Integrating a treasury is very important and it's the need of the hour. So any bank treasurer, bank person who has joined us, please try and understand this concept that we have to consciously work towards integrating our treasury, which we are not doing at the moment. And we are losing on efficiencies because of that. Okay, so quickly I'm going to tell you about this. Any trader, it's a repeat of what we did the other day. To be a successful trader, irrespective of the asset class, what you require are certain building blocks. Any trader, when they start, it is very imperative that you have knowledge, you do research, you do a good background work, right? If you heard that thing that if you, the person who sweats the most during peace bleeds the least during war. Because if you researched well, if you've done your background well, when you see the situation, when the situation comes, you are able to take good decisions. And that's how a good trader has to compulsorily have a good knowledge, should have done his background homework. Need to be disconnected with emotions. Emotions play a huge barrier to successful trading. You have some distraction with respect to something at home, you have some other thing going in your mind while trading, and you eventually are unable to take the right decision. So disconnecting from emotions is very important. Once you are able to do this, you become a prepared trader. You prepared yourself to trade. Now at 8:45 before market starts at 9 o'clock, you need to do this. You need to become prepared. And then focus, concentration, and discipline. Without this, any trader is going to eventually lose out. Very, very important building blocks of a good trader. And once you have these things in place, only then you become a good trader. A good trader needs to develop fast decision making and also have patience. Why I have put both the things together is this. There are times when I see an opportunity, but I'm unable to hit it at that time, unable to take advantage of that. I know that यहाँ से 10 पैसा ऊपर जाने वाला है वहाँ. But should I buy? Should I not buy? Should I put it at 5 paisa lower than this? I missed the level. That is because I couldn't take a decision fast. Then sometimes what happens is I put in the trade, but my trade didn't happen. Sometimes patience is also very, very important. You should not go in and, okay, I missed this level. Let me put it 10 paisa higher. Let me put it I was supposed to buy at 100.50. It moved to 100.70. My target was 180. So at 170, I lose patience and buy out there for that 10 paisa. And when it moves downwards, I lose that 20 paisa that I was. So never get impatient in trading. Have fast decision making, but also have patience. You need to know where to go and where to stand back. So a person who has these qualities becomes a better trader. And very, very important 2 points is humility. You need to, however much you have traded, how many ever years you have been in the market, irrespective of the number of years or the number of trades you've done, you need to have the humility that you can go wrong. Your view can go wrong. You need to have a fallback option. If my view goes wrong, this is what action I am going to take. You need to have that humility to believe that you are not God. Your trade has to happen. Arey, war ho gayi, fir bhi market nahi gir raha hai. That's okay. That's possible. You can get that wrong. You read it that there is a war and the market should crash, but it did not. Now that it did not, what do I do next? Should I cut the shorts that I had built and go long? Maybe you should, right? Humility to accept your mistake and then learn from it and become better is very important. And you should never be rigid. Some people I've seen, यहाँ पर short करना, यहाँ पर तो long करना चाहिए. For example, gold. Gold, I've been feeling that it is very cheap at 45 levels. It comes down to 43. Obviously, if it was cheap at 45, it's cheap at 43. It comes down to 40. Even cheaper. But should I buy at 40? I don't know. You need to analyze it objectively, not be rigid in your thought process that no, it is cheap. It may not be. You are seeing, maybe you are not seeing something that the market is seeing. Because at 45, you thought it was cheap, and market thought that 40,000 is the price. That's why it has got it down. Never be rigid. Only if you have all these building blocks can you become a master trader, irrespective of the asset class. Okay, just to end the session, I'm going to leave you with some words of wisdom. I already said this one. A warrior who sweats the most during peace bleeds the least during war. You have to be prepared. There is no alternative to hard work. There's no alternative to your study, your homework. You have to understand the asset in and out before you get into it. Chess, a game that I love, is played more in the mind than on the board. You make infinitely many moves in your mind than you make on the board. You tested at least 15 moves in your mind that if I play this, the opponent will play this, then I will play this, then he will play this. And finally, you decide which of those moves will you play on the board. In trading, exactly that's what happens. You analyze infinite asset classes and then decide, I want to allocate my money to this one right now. What will happen to this asset class? If my view goes wrong, then what is the action that I can take? Will I be able to recover my money if my view goes wrong? If I can't, I will not go for that trade. So more number of trades actually go through your mind than you actually execute on these things. Trading on tips is a total no-no, please. Okay, having trading discipline is only the beginning. Keeping discipline in is progress, and staying disciplined throughout is success. What I mean by this is very clear. At the beginning of a particular trade, you've decided that this is my stop loss. First of all, don't do any trade without knowing what is the maximum I can lose from that trade. That is your stop loss level. If the stop loss level is hit, period, close out that position. No, even if you feel that, again, the same example, at 45,000, if I felt it was cheap, 43,000 is my stop loss. Obviously, I feel it is cheap at 43,000, but I will cut it out. I will reanalyze. Maybe there is another asset class which I can earn from. Why do I need to earn from that asset class only? My objective here is to earn money, not earn money from gold, earn money from Reliance, earn money from Infosys. That's not my objective, right? So I can do that by any other asset class, but discipline is very, 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 very important. It is okay to get a view wrong. What matters is accepting your mistake and learning from it so that next time your views are better. A very inspiring photo number that I have put on the screen. If I become a little better every day, by the end of the year, I am significantly better than what I was at the beginning of. However, if I slip my game a little every day, I become almost nothing by the end of the year. 0.99 raised to power 365 is 0.03, which is almost next to nothing. But 1.01, a little more than what I was yesterday, 365 days, I'm 37.8 times what I was a year back. It is very inspiring. All I'm asking everyone who's seeing this to do is strive to be a little better than what you were. आज कुछ सीख के जाना है. यहाँ से कुछ लेके जाऊंगा. I will be a little better than what I was an hour back. Thank you very much. Now open to questions. Anyone who has a question on the other side also, please feel free to ask.
Why you say that when it is inverted yield curve, like in US right now, why is that feeling that recession is about to come to the people? Sorry. Because of inverted yield curve, economists say that recession is likely to come in next 1 or 2 years. What is the correlation and how sure it is?
So typically an inverted yield curve is a precursor to recession throughout history. What it says is that I expect, what is an yield curve? I expect the interest rates to be lower. If I give you money today for 30 years, I am expecting lesser money from you than I give you money for 5 years. Right? That is what the curve is saying. My expectation is lower for the future because I feel that things will not be that good in the future. Right? So what I'm trying to say is that I'm expecting the markets, or rather the economy, to go downward, to have a recession. Typically, an inverted yield curve is a precursor to recession. It is not necessary.
Right.
There have been times when inverted yield curves have been corrected very, very fast by central government. They've acted, but it is a very...
it's like a signal.
It's a signal. It's definitely a signal, and it's a difficult thing to do. Now, it was a cakewalk for central banks for so many years to print money, borrow at absurdly low cost, negative interest rates in Europe, in Japan for so many years, borrow at negative interest rates and spend that money. मेरा थोड़ी है तो किसी और से लेके खर्चा कर रहा हूँ. It's so easy to spend that money, right? It was a cakewalk. But when inflation starts, and even then the inflation did not cross 2%, they were all targeting to bring it up to 2%. Now that US inflation is almost at 8%, it's crossed 8%, I think. So it's US inflation at 8%, they've not seen that prices can go up to those levels every year. If I can go and buy something this year, tomorrow if I'm going and buying the same thing, it will be 8% expensive. Really? That's what happens. We've seen it in India. We've seen those things happen, but they haven't. An entire generation of US citizens have not seen that. For growth not being there and inflation being so high, the term used is stagflation. Stagflation is a very, very dangerous snake. It is very difficult to combat, and central banks have to preempt it and act ahead of the schedule rather than behind, which is what you would have heard. They are behind the curve, they are behind the this into act, and that's what's happening right now. If inflation goes even higher, it becomes very difficult to control. Then what do? I look at it this way. I, as a consumer, feel that okay, I have to buy a TV. I'll buy it whenever I have the money. But I realize that this TV is going to be 8% or 10% costlier next year. So I prepone my purchase. Because I prepone my purchase, supply remains the same. The demand starts increasing. Because the demand starts increasing, the price goes up. Now it's a vicious cycle. Because the prices are going up, more people are coming and buying television. And it becomes a vicious cycle. How do you break the chain? You can't increase capacity overnight. You can't start producing so many TVs, and then you know that after certain this TV was about to be sold a year later. So a year later there will be no demand. So if I today put up capacity in my factory, what will happen to that capacity after a year? Who's going to buy? Because people are only preponing. They are not adding to purchases. Please try and understand. The number of units will remain the same. So that is why supply doesn't go up and demand starts moving up in inflation situation. And then it becomes a complete mayhem, which is why central banks find it very difficult. And inflation is something that they need to address very fast, which is what the RBI also said in the monetary policy. They also took cognizance of it. They became suddenly hawkish just because they realized they are being behind the curve. So you had a question.
People particularly who trade in
Be little louder.
people who
I'll
trade
repeat
in
the question.
yeah, and your reading of the interest rate, it helps you to understand more the stuff.
Definitely, sir. Okay, so the question is that if I am a USD INR trader only, would my reading of inflation, interest rates, and the macroeconomics help me determine the dollar rupee rate? Definitely, sir. Dollar rupee actually is nothing but the movement of one currency with the other, which is in turn defined by the interest rates of one currency vis-a-vis the other. So the forward curve, entire forward curve of your dollar rupee, which can be a proxy of where your dollar will be. It is not definitely, but I'm saying that it can be a proxy of where my dollar should be 1 year hence. Correct? Which is how you book forward and hedge. So if that is a proxy to where my dollar rupee will be 1 year hence, what is that? Interest rates in India minus interest rates in US percentage multiplied by the present rate of dollar rupee. So unless I know the interest rate, how do I know the movement of dollar rupee? Just to answer that, it is very, very important and totally interconnected. I see some 5 chats. If there are questions on the chat, you can. Anyone here else has questions?
Yeah. So you mentioned bull speed, that the shorter bonds go down and longer bond yield.
They may move up or they stay where they are.
Right. So that entire curve
becomes steeper.
Right.
But downward.
Okay.
So it's bull.
So it's bull because the shorter yields are going.
If yields come down, you make money on the long position. Bulls are long, right? Bulls are people who hold long. Bears are the ones who hold short.
Right.
So that is why the term given as bull speaking.
Now, if so retailers we can trade in IRS.
Yes.
So what you buy the shorter term?
By the if your view is that there will be a bull steepening, you buy the shorter term and you sell the longer term. You are completely hedged. How much you need to sell depends on the PVO1. So you need to calculate that. You need to figure out how much you need to sell of the longer term to keep a PVO1 neutral position.
On which platform do we trade like IRS, IRS?
NSE, BSE,
NSA is it actually traded now?
IRF is, IRO is not. In fact, even in IRF, very few securities are traded actively. See, ultimately, who are the holders of the underlying? Banks and PDs and large organizations. These people are not coming onto the exchange platform.
Particularly,
If they participate, then there can be liquidity which can come in, and there is a huge amount of arbitrage.
actually, any borrower where he is paying the interest, he can use this mechanism to protect his.
Exactly, it's a perfect hedge. If you're paying interest, if you're a borrower, it's a perfect hedge.
And a person who is aware the household expects the rate to go, if he can get to the IRS.
Yes. Every single person who has any exposure to interest rate.
People know. Okay, the other thing is that here it is that your understanding well. And when it goes up, when it comes down, it is correlated with your interest rate, but correlated with your inflation. It is correlated with the interest rate outside the country.
Yes.
That's the way since you are exposed to the global.
Everything, sir, is correlated, and unless you study the combined effect of entire macro perspective, you can't take a very informed call. It doesn't mean that you won't get it right. There are times when people just go and take a. I mean, it's the best of the traders get it about 60% right. Correct. And if you flip a coin, you get 50% right. So the entire game is about 50 to 60. That's all we are talking about. So I mean, if you're totally unread, you come for the first time in a particular market, you buy, you may make money. You may. Right? People are unable to hear most of the time. Okay. Was there a problem with the time? The time period. So thank you, Saurabh, for your time and your inputs, and I hope all of you had a good time. And whoever needs to get more information, Saurabh, and send it to the person who invited you today. I'm talking about people in the online also. So thanks once again, Saurabh, and all of the people who are there present. Thank you everyone for coming here. Good night.